Bankruptcy fraud, concealing assets, making false statements on schedules, lying at the 341 meeting, is a federal crime that carries serious penalties, but it happens with surprising frequency, and exposing it requires knowing what to look for. Here are the most common techniques debtors use to conceal assets in bankruptcy proceedings, and the investigative approaches that surface them. Transferring property before filing. The most common pre-bankruptcy concealment technique: transferring real estate, vehicles, cash, or other assets to a family member, domestic partner, or friendly entity before filing. The debtor files with nothing to disclose, but the transferred assets exist and may be recoverable as fraudulent transfers. Professional asset investigation, comparing the debtor's asset history against current disclosures, identifies these transfers. Understating income. Self-employed debtors, business owners, and cash business operators have the most opportunity to understate income in bankruptcy schedules. The bankruptcy means test uses current monthly income, a specific defined term based on all income over the prior 6 months. Cross-referencing the debtor's reported income against tax returns, bank deposit records, professional license filings, and business registration records can reveal discrepancies. Omitting assets from schedules. Required disclosure covers all property the debtor owns or has an interest in, not just property in their name. Beneficial interests in trusts, partnership interests, accounts receivable from businesses, pending lawsuits where the debtor is a plaintiff, and inheritance rights are all property that must be disclosed. Omissions are often the most vulnerable point in a fraudulent bankruptcy. Using nominee ownership. The debtor owns property in name through a relative, friend, or nominee, paying the expenses, exercising control, receiving the benefit, but not having the legal title in their name. Professional investigation of the associated person's assets sometimes reveals these arrangements. Concealing business interests. A debtor who owns or controls an active business through a family member or associate while claiming no business interests in their schedules. Business registration records in all states, operating permits, professional licenses, and commercial credit reports all potentially reveal undisclosed business activities. Inflating secured debt. Claiming larger secured debts than actually exist reduces apparent equity and reduces the amount available to unsecured creditors. Verification of claimed secured debts against public lien records identifies inconsistencies. People Locator skip tracing provides comprehensive bankruptcy fraud investigation for creditors and trustees. Visit peoplelocatorskiptracing.com to place your order.